All right, so chapter 5, learning objective 3, same invoice, but now we're looking at it from the seller's perspective. Okay, from the seller's perspective. As you know, the seller is PW Audio Supply all the way up in Michigan. Okay, where you think it's cold here, it's colder there. And so how they look at this invoice is interesting. They also need to know the date. They also need to know what terms they've extended so they can be ready with a special account for that. They need to know when it's no longer their inventory because they're selling inventory to another business, right? And of course, they have to know what the sale is. Important to know, not just this is what they sold it for, right? That circuit board was sold to Sock Stereo for $2,300. Okay, that's what they sold it for. Question, what did it cost them, right? Because remember how merchandisers work. They have to either make or buy the stuff first before they can sell it to the third party. So PW Audio either had to make that circuit board or buy that circuit board before they sold it to Sock Stereo. So one of the things you're going to notice here is this is the sales amount of them selling, not the cost of what it costs them to sell it. And that's going to be one of the big differences from the seller's perspective. You're not just recording a sale of goods. You also need to record the cost of those goods because the merchandiser had to create it or buy it before they sold it. So that's where the cost of goods sold is going to come in, as you'll see. So every time there's a sale from one business to another, okay, or from one business to a customer, okay, even you and me talking. Notice it's two parts. There's a two-part journal entry that needs to be done. The first thing they need to do is record the sale. Okay, they need to record the sale. And so the selling price of the sale, whatever, so that circuit board was X dollars, those circuits were X dollars, that's the selling price. So, and that particular invoice indicates that they're going to be waiting to receive the money later. So the invoice to the seller is an accounts receivable. It's an accounts receivable. They're waiting to receive payment on that sale. So they're going to be debiting the accounts receivable and they're going to be crediting sales revenue. Again, sales revenue, the word sales indicates selling of a good, a physical product, right? If it were you and me going into a retailer to purchase something, of course, we would not have that same benefit of getting I'll pay you later for it. We're going to be paying cash, whether that's actual cash or a credit card. They look at it as a cash sale. Okay, you get a bill from the bank, not from the merchant. Okay. So it's a cash sale. Sales revenue. So the first thing they have to do, record the sale. The second thing they have to do is record the fact that they just sold some of their inventory to the customer. Like I said, PW Audio just sold a circuit board and circuits to Sock Stereo. So they have to record two things: the cost of goods sold, and they have to take it out of their inventory. Okay, so the cost to the seller is the cost of goods sold. This is an expense account. So we're going to be debiting the cost of goods sold because it's an expense account. We're going to be crediting the inventory because the seller just sold the inventory to the buyer. It's no longer theirs. They got to reduce it. So that's the two parts. So this is important right here. I'm going to put a little star. Oh, it's not a really great star here. Doesn't even look like a star, but it's a star. These are the journal entries you have to remember for a seller every time there's a sale. So let's see how it works. You might remember PW Audio, has to record the sale of $3,000 on May the 4th to Salk Stereo. We need to know the costs. So we're going to assume, in this case, you're going to get additional information for sellers. The cost to PW is $2,400. So the first thing is we record the sale. The second thing is we record the costs. So let's record the sale. It's an invoice. That's a receivable for us, $3,800. We just made a sale. Sales revenue for us, $3,800 on the credit side of revenue, debit side of receivable. Now we record the cost, which is that extra number they give you. Cost of goods sold, $2,400. Inventory, $2,400. They sold $2,400 worth of inventory to Salk Stereo for $3,800. The $3,800 of sales revenue will show up on the income statement as a sale. The cost of goods sold will be the $2,400. That's the cost of their inventory. The difference between these two numbers, you remember from last time, is the gross profit. Okay. So the difference between sales and cost of goods sold is the gross profit. Right? You can tell that just by looking at these numbers. Fascinating, Arujo, tell me more. Okay. Don't push me. Here we go. So remember, when they sent that shipment to Salk Stereo, they opened the box and they said, we bought too many circuits. We're going to send it back, right? Well, how the seller sees that is something called a sales return allowance. This is an actual account on the seller's books, okay? It's actually something called a contra revenue account. It's considered a revenue account, but with the opposite balance. Remember, the word contra in accounting indicates that it's the account with an opposite normal balance. Revenue accounts have normal balances on the credit side. However, sales returns and allowance account is a contra revenue, so it'll have a account balance on the debit side. All right, that's the contra. It's the flip side. Just don't flip out. Okie dokie. All right, we don't reduce the sale. We want to make sure sales revenue shows everything that we have sold. It's very important that businesses keep track of what's being returned, because they're not in the business of getting merchandise back that they just sold. They're in the business of selling stuff. They want to sell everything. They don't want it back. The fact that some people return certain items is very important information, because why would Walmart want to stock an item that people just keep returning? They'd probably drop the item. Right? That's not their business is not to incur those types of problems. They want to sell stuff and see the customer off happy. They don't want the customer coming back and returning stuff. No business does. So this is important to keep track of separately, because it gives the business very, very important information. And it won't distort what the actual sales were. The fact that business sold certain things was very important. That's important to know. The fact they got it back, or some of it back, is also important to know separately. So here's the illustration. Remember, Salk Stereo ended up sending back one of those $300 circuits to PW Audio. Question for retailers is, once they get merchandise returned, can they resell it to another customer? Well, certainly if it's not defective and there are no other types of restrictions, they can sell it to another customer. So they will put it back in their inventory for resale to another customer. Okay. So remember, when they're putting it, two things happen when there's a return. They have to note the return of the merchandise based on the selling price, but then they have to put it back in their inventory to sell it to somebody else. So this is also going to be a two-part entry. First part, they're going to record the return. Sales returns and allowances will be debited by $300 to show that was returned. And of course, since it's returned, they're not going to get payment on it. So accounts receivable must also be reduced to show they're not waiting to receive that money for this. Second thing is they got to put it back in their inventory to sell it to somebody else, which also means, and this is the weird part, they have to reverse the cost of goods sold. So they'll debit inventory to put it back in their inventory to say that, we can resell this circuit to another company. There's nothing wrong with the circuit. They just bought too many units, didn't want it. But that also means they have to reverse out the cost of goods sold. Normally speaking, remember, cost of goods sold is a expense account. We've almost every time to this point, every time we've seen an expense account, it's always been debit, 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 because that's what expenses do. We only credit the debit expense account at the end of the cycle to close the books. Well, cost of goods sold is one of those very strange accounts, which you're going to see in enormous amounts of credits on this expense account, because every time something is returned and it's something that they can resell, they're going to put it back into inventory and they have to reverse out the cost of goods sold. That's just how this account is affected. It's the only expense account that sort of works this way. Okay. So that's something to know. Again, two parts, part one, part two, just like the sale. Your book shows here, and again, what happens if they were defective? What happens if that circuit was really a defective circuit, and that's why they returned it? Certainly, PW Audio could not resell that to another company. It'd be crazy to do that, right? So when you and we're very fortunate to live where in an era that manufacturing is incredibly good. Okay, the defection rate on many items is well below 1%, fractions of 1%. Versus when I was sitting in your seat many moons ago, the defection rate was 5% or so, 4 or 5%. So the fact that we have, computer automated manufacturing and computer automated design, and we just have manufacturing running very smoothly at this point. So the defection rate is very low. But what happens once you, of course, if a good has a lot of parts, your defection rate is higher. If your good doesn't have as many parts, your defection rate is probably going to be low. So the more complex the good is, the more likely there might be something defective. But for the most part, we live in a world where defection is low. So let me get my point. What happens when PW Audio gets a defective good? They can't sell it to another customer. It would not be in their interest. So what they usually do is they mark it with a scrap value. Okay. They do have to claim that they have to put it back in their inventory. They do have to reverse something out of their cost of goods sold as well. But they are going to mark it with a special scrap value. I don't know why they picked $50. I would have picked some odd number like 19 or 9, something that sticks out, that when you see that, oh, that's a defective product. Every company can choose whatever their scrap value is, but certainly you're not going to resell it. You're going to either send it back to the manufacturer for a new one, because they're usually very good at that. Or if you're the manufacturer, you'll send it back to make sure it won't happen anymore and get that back in stock. So in this case, we are showing the same return. That $300 circuit was returned. But in this case, the circuit was defective. We're not going to be selling it to another customer. So we're just simply going to note in inventory and cost of goods sold that we have more inventory, but it's a defective item. So it's going to be a special number. And they can make it up. Like I said, I would have picked an odd number like 9 or 19. And they will reverse it as well on cost of goods sold, again, to show that defective item was returned. Luckily, like I said, we live in an age where you don't have to worry about this all that much. All right, remember, part of the invoice to Salk Stereo was, look, if you pay us early in 10 days, you can take a discount. Well, how does that discount look if you're the seller? Well, here's another account. Sales discounts is another contra revenue account that you're learning about today. It works very much like sales returns and allowances. It has a debit side balance to show that our sales revenue was reduced, in this case, because discounts were taken. Okay. It's important that we collect our money promptly. No, question about it. So discounts do play a role, but discounts don't reduce sales revenue. We still sold it. It does show, however, um, the number of people who are taking advantage of paying us quickly and whether that program is actually working or not. So this makes for a very interesting box that you need to know about, because you're going to see this on a very detailed income statement. Companies record their sales revenue. Okay, sales revenue, revenue account, credit balance. They show you, they will subtract out their sales returns and allowances. Sales returns and allowances, contra revenue account, debit balance. So it shrinks that. Sales discounts, again, promoting that prompt payment within 10 days, shows on the debit side, they're going to subtract out that. So sales revenue minus sales returns and allowances minus your sales discounts is something that you'll see on income statements as net sales. Okay. When you look at an income statement for any corporation that deals with products and goods, the very first line you'll often see on the income statement is something called net sales. Now you understand what that means. Net sales is, in essence, the product of the sales revenue minus sales returns and allowances minus the sales discounts. This is the actual net sales. So I put a little star here to say you have to remember this. You have to remember you're going to be seeing net sales a lot. You need to know how we got it. All right, so now Salk Stereo is going to be paying us. Woohoo! Okay. What happens when they pay us on the 14th, right? Which is the last day of the discount. Well, that means we're going to be receiving less money, right? We were expecting $3,500. That's what we're waiting to receive. However, because they're taking advantage of the discount, we're clearly going to be receiving a little bit less. So how do we take care of that as the seller? We are going to show that we collected $3,430 of cash, which reflects a $70 sales discount. Notice sales discount gets a debit along with cash. We did collect our entire receivable. The $3,500 receivable will be wiped off the books with a credit. So that's going to be the journal entry for the seller when they collect money with a discount. Of course, it's very easy when they don't have the discount. It's just a debit to cash, credit to accounts receivable. Okay, here's the exact same two companies, De La Hoya and Juno Diaz. But now we're looking at it, do an exercise from the seller's perspective, right? So let's review. On the 5th of September, De La Hoya buys merchandise on account from Juno Diaz. We're the seller. Juno Diaz is the seller. The selling price is $1,500. The cost is $800. 2. On the 8th of September, De La Hoya returns goods for $200. It has a cost of $105. So we do two things. First, we're going to be recording the sale, which is what happened on the 5th. Second, we'll record the return, which happened on the 8th. So on the 5th, again, anytime there's a sale, we have to do two steps: record the sale and record the cost of the sale. So in this case, we had a sale of $1,500. Accounts receivable gets a debit. Sales revenue gets the credit for $1,500. And we sold them $800 worth of our inventory. So we are going to debit cost of goods sold, $800, and credit our inventory because we sold it. Next thing is on the 8th, they returned $200 worth of stuff to us that's not defective. Okay, so we can resell it. So in this case, we're going to show on the 8th, we sales returns of allowances of $200 because that was our selling price. And we're going to reduce our receivable by 200 because we're not going to be receiving that money. On the 8th, also because we can resell this to somebody else, we're going to put it back in our inventory by debiting inventory. And we're going to take it out of our cost of goods sold. And we're done. So, questions on the seller's perspective?